Did you know that keeping large sums of cash in a traditional savings account could actually cost you money? It sounds crazy, but it's true. Between inflation eating away at your purchasing power and banks offering rock-bottom interest rates, your so-called safe cash is slowly losing value every single day. If you're holding thousands, or maybe tens of thousands, in your savings account because you believe it's the safest option, think again. In today's economy, cash sitting idle in a bank is one of the riskiest strategies you can choose if your goal is to protect and grow your wealth. In this video, I'll share 6 powerful assets that are safer and far better than keeping your hard-earned money locked up in a traditional bank account. These are strategies the wealthy have been using for decades, and it's time you start considering them too. So grab a notebook, because this isn't just theory, this is about making your money work smarter. Welcome back to Millennial Money Moves, the channel where we teach you how to make smarter financial decisions, build long-term wealth, and secure your financial future. Before we dive into the 6 assets, let's set the stage. We live in a time where the global economy is changing rapidly. Bank savings rates haven't kept up with rising inflation, meaning your dollar today won't buy as much tomorrow. Central banks print more money, governments increase debt, and the value of cash continues to erode quietly. The ultra-wealthy have known the secret for years: cash is not king, cash flow and assets are. Instead of letting their money sit, they channel it into assets that grow, produce income, and retain value even when markets are volatile. And today, I'm going to break down 6 of the safest, smartest, and most effective alternatives to parking your money in a bank account. Let's get one thing straight: keeping some cash for emergencies is smart. But keeping too much cash in your bank account? That's where you run into problems. Here's why. Inflation erodes value. A steady 3 to 5% annual inflation rate means your $10,000 today could be worth less than $7,500 in 10 years. Bank interest rates are low. Most savings accounts pay 0.5% to 1%, which doesn't come close to offsetting inflation. Hidden bank risks: banks lend out your deposits, and in extreme cases, as seen during financial crises, accounts can even be frozen. Opportunity cost: every dollar sitting in a savings account is a dollar not working for you. Bottom line, cash should be liquid but not idle. The key is to balance your emergency fund with assets that protect your wealth from inflation and volatility. Asset number 1: high-yield savings and money market funds. The first step isn't to abandon cash entirely, it's to optimize where it sits. High-yield savings accounts and money market funds offer better returns than traditional banks without sacrificing liquidity. These accounts typically pay 3% to 5% annual yields, allowing your cash to work harder while remaining accessible. Money market funds, in particular, invest in short-term, low-risk securities, making them safer than stocks while outperforming most savings accounts. However, remember this: these accounts won't make you rich. They're designed for parking cash temporarily, earning better interest while you prepare to invest elsewhere. Asset number 2: U.S. Treasury bonds and T-bills. For decades, U.S. Treasury bonds have been considered one of the safest assets in the world. These government-backed securities are perfect for investors looking to protect capital while earning modest, guaranteed returns. Short-term Treasury bills are especially attractive right now, with yields often outpacing inflation. Unlike banks, the U.S. government backs these assets directly, giving you far more security than a checking account. Treasuries are excellent for risk-averse millennials who want to diversify their savings strategy while maintaining liquidity. Asset number 3: index funds and ETFs. Now we move into growth-focused assets. If your money is just sitting in a savings account, it's missing the opportunity to compound over time. Index funds and ETFs, exchange-traded funds, are low-cost, diversified investment vehicles that track the performance of entire markets. For example, S&P 500 ETFs let you invest in 500 top U.S. companies. Total market funds provide broad exposure to thousands of stocks. Over the last 30 years, the S&P 500 has delivered average annual returns of 8 to 10%, far outpacing savings accounts and inflation combined. Asset number 4, precious metals. Before we dive into the next asset, a quick reminder. If you're finding this video helpful so far, hit that like button, subscribe to Millennial Money Moves, and drop a comment telling me which asset you're considering first. Now, onto asset number 4. Precious metals like gold and silver. In times of economic uncertainty, investors flock to metals as a safe haven. Gold, in particular, has held its value for centuries and tends to rise when inflation spikes or markets get shaky. For millennials, holding 5 to 10% of your portfolio in precious metals can act as an insurance policy against currency devaluation and financial crises. Asset number 5, real estate investments. Real estate remains one of the most powerful wealth-building tools available. Whether it's rental properties, REITs, real estate investment trusts, or crowd-funded real estate platforms, owning a stake in property can generate steady cash flow and long-term appreciation. Millennials often shy away from real estate due to perceived costs, but with fractional ownership platforms and REITs, you don't need six figures to get started. The goal isn't just to buy property, it's to invest in income-generating assets. Asset number 6, dividend stocks. Finally, we come to dividend-paying stocks, one of the most underrated wealth strategies. These are companies that share a portion of their profits with shareholders, providing steady income on top of stock growth. Imagine earning quarterly cash payments while your shares appreciate in value. Companies like Apple, Microsoft, and Johnson & Johnson have a long history of paying reliable dividends, making them ideal for millennials seeking passive income. So, let's recap. High-yield savings and money market funds. U.S. Treasury bonds and T-bills. Index funds and ETFs. Precious metals. Real estate investments. Dividend stocks. Keeping your cash in a bank might feel safe, but it's one of the least effective strategies in today's financial climate. By diversifying into these 6 assets, you protect your wealth, beat inflation, and create multiple income streams. If you found this video valuable, like, subscribe, and hit the notification bell so you never miss a financial growth tip. And drop a comment below, which of these 6 assets will you start with first?